$700 billion. Let that number sink in for a moment. That is the combined capital expenditure that Amazon, Google, Microsoft, Meta, and Oracle are planning to spend in 2026 alone. To put that into perspective, that figure is larger than the entire GDP of Sweden. It is more than the entire U.S. defense budget for procurement. The mainstream media calls this an AI boom. They tell you it is the dawn of a new industrial revolution. They show you shiny demos of robots and chatbots to distract you from the financial reality. But here at After Hours Alpha, we do not look at the demos. We look at the balance sheets. And the balance sheets are screaming a very different story. This isn't a boom. This is a hostage situation. Amazon and Google aren't spending this money because they see a clear path to immediate profit. They are spending it because they are terrified. They are locked in a prisoner's dilemma where the first one to stop spending loses their dominance. But here is the dirty little secret they won't tell you on CNBC. The money they're burning used to be your money. It used to be your dividends. It used to be your stock buybacks. Today, we are going to dissect the great capital rotation. We will look at why Amazon and Microsoft are technically entering a bear market despite record spending. We will uncover the shadow debt structures like Meta's Beignet SPV that act as financial camouflage. And most importantly, we will answer the question on the thumbnail. If big tech is footing the bill, who is actually cashing the check? This is not investment advice. This is a forensic audit of the largest wealth transfer in history. Let's cut the noise and look at the data. Wall Street loves to say that this time is different. But history never repeats itself, it rhymes. And right now, it is rhyming perfectly with the year 1850. According to analysis from FinViz and the Wall Street Journal, the current tech Capex spending has hit 2.1% of the entire U.S. GDP. The last time private capital was mobilized at this scale for a single infrastructure build-out was the railroad mania of the 19th century. Let's look at that parallel because it predicts exactly what happens next. In the 1850s, railroad companies issued massive amounts of bonds to lay tracks across America. They operated on a simple belief that if you build it, they will come. And they were right. The tracks did eventually transform the global economy. But here is the catch that the AI bulls conveniently forget. Almost every single railroad company went bankrupt first. The investors who funded the tracks got wiped out. The bondholders took a haircut. The value didn't go to the builders of the infrastructure. It went to the users of the infrastructure decades later. Fast forward to 2026. Amazon has confirmed $200 billion in spending. Alphabet is targeting $185 billion. They are laying the digital tracks, which are the GPUs, the fiber optics, and the data centers. But ask yourself if the freight is ready. Goldman Sachs warns that the killer app for AI is still missing. We are building a distinct infrastructure for a traffic jam that hasn't happened yet. This is what we call hyperspending. S&P Global recently flagged that this 60% year-over-year increase in spending is putting massive pressure on free cash flow. When you build infrastructure out of fear rather than demand, you inevitably create a bubble. And when that bubble pops, the physical assets remain, but the equity in your stock evaporates. Now, let's get into the weeds. This is the financial engineering part that Wall Street hopes you are too distracted to notice. Where is this $700 billion coming from? For the last decade, the Magnificent Seven trade was simple. These companies were cash printers. They operated with 90% gross margins. They took their massive profits and bought back their own shares. This reduced the share count and artificially inflated the stock price. It was a beautiful and virtuous cycle for shareholders. But that cycle is dead. Data from Wall Street reveals a shocking pivot. Amazon has had 0 share buybacks since the second quarter of 2022. Think about that. One of the largest companies on earth hasn't returned a single dollar of capital to shareholders via buybacks in years. Why? Because they are funneling every spare cent into Nvidia's pockets. Meta and Alphabet have also slashed their buybacks significantly from their 2021 peaks. But it gets darker. They aren't just spending cash, they're taking on debt. Oracle just raised $25 billion in the bond market. Amazon raised $15 billion. But the darkest secret is how they are hiding this debt. Let's talk about Beignet. No, not the French donut. Beignet is a special-purpose vehicle created by Meta. Why would a tech company need an SPV? They use it to build a $10 billion data center in Louisiana without putting the debt directly on Meta's main balance sheet. This allows them to keep their credit rating pristine while leveraging themselves to the hilt. This reminds us of the off-balance sheet vehicles we saw before the 2008 crash. It reminds us of Enron. When a company with $80 billion in cash starts using shadow debt structures to fund construction, you know the ROI is not immediate. They are mortgaging their future to stay in the AI race. As an investor, you need to understand that the era of capital return is over. We have entered the era of capital destruction. Here is the second layer of the zero-sum game. While the hardware companies are partying, the software industry is quietly entering a recession. Why? Because every dollar spent on a GPU is a dollar not spent on a software engineer. Look at the layoffs in 2025 and 2026. The tech sector is shedding jobs, yet Capex is at record highs. This is the cannibalization of SaaS. Companies are firing humans to buy silicon. But is the silicon doing the work? Let's look at the revenue reality. Microsoft has roughly 450 million paid commercial seats for Office 365. These are the most loyal corporate customers in the world. After 2 years of nonstop hype, Super Bowl ads, and billions in marketing, how many have upgraded to the paid Copilot AI? 15 million. That is roughly 3%. Imagine if Apple launched the iPhone and only 3% of iPod users bought it after 2 years. The stock would be at zero. And look at OpenAI. They are generating revenue, yes, but their costs are astronomical. What did they just announce? Ads in ChatGPT. Think about the irony. We were promised artificial general intelligence. We were promised a god. Instead, we got a chatbot that serves banner ads. This is a sign of desperation. It means the subscription model isn't covering the electric bill. It means the unit economics of AI are broken. Big tech is caught in a trap. They have to spend $100 billion to build the model, but they can only sell it for $20 a month, and most people won't even pay that. This is the adoption gap. The Capex is exponential, but the revenue is linear. In finance, that is a recipe for a margin crush. And we are already seeing it as Morningstar reported that Amazon and Microsoft stocks have technically entered bear market territory because investors are waking up to this reality. But there's a physical wall that nobody is talking about. Even if these companies have $700 billion to spend, they cannot buy more electricity than the grid can provide. In Northern Virginia and Silicon Valley, the waiting list for a power connection is now 5 to 7 years long. This means big tech is buying billions of dollars worth of Nvidia chips that will sit in boxes because they cannot plug them in. This is the ultimate stranded asset risk. They are paying for hardware today that will be obsolete by the time the power plant is built. This is why you're seeing Microsoft try to restart 3 Mile Island. They aren't doing it to be green. They're doing it because they are desperate for electrons. So who gets paid? Who is on the other side of this $700 billion transfer? It's not just Nvidia. That trade is crowded. The real alpha is in the physical constraints. You cannot run a Blackwell cluster on hopes and dreams. You need megawatts. The grid is the ultimate bottleneck. And the companies that control the electrons are charging a premium that makes SaaS margins look pathetic. Look at Vistra and GE Vernova. These are the boring utility and power infrastructure companies. But in 2026, they're the new gold miners. Why? Because Amazon needs them. Microsoft needs them to restart nuclear plants. The negotiating leverage has shifted. Big tech is begging for power, and the utilities are setting the price. And look at Broadcom. While everyone looks at Nvidia, Broadcom is quietly winning the custom silicon war. As Amazon and Google try to build their own chips to escape Nvidia's tax, they have to pay Broadcom to help design them. Broadcom is the toll booth operator on the highway to AI. Here is the bottom line for your portfolio. The $700 billion spend is not a sign of health. It is a sign of panic. Big tech is entering a cycle of lower margins higher debt, and zero buybacks. The money is leaving the software ecosystem and moving to the hard asset ecosystem, which includes chips, copper, uranium, and land. Don't be the exit liquidity for a Capex bubble. Stop chasing the hype. Start tracking the bill collectors. Because when the music stops, they're the only ones who will have a chair. If you want to survive the capital rotation, you have to look at the numbers, not the narratives. The era of easy money is gone, and the era of real assets has arrived. This is After Hours Alpha. We don't sell dreams. We track the nightmare. Check the description for the raw data sources from Wolf Street and S&P Global. If you want to stay ahead of the curve and protect your wealth from the coming margin crush, subscribe and stay paranoid. I will see you in the next breakdown.